And we're gonna start admitting them, but we won't start the meeting for a few minutes.
Okay.
Thank you for joining us today. We're going to give it a few more minutes to let people get organized and onto the webinar. Be with starting shortly. We have a few more people starting to log on, and then we'll get started. Thank you for joining us today. Good afternoon, and thank you for joining us today. My name is Justine Bachman. I'm the Congressman's Outreach Manager, and on behalf of Congressman McKenzie and our office, we appreciate that you're taking the time to join this webinar today and learn about our new tax laws and the tax credits applicable to your business and the business owners for the 2025 tax year. Today's session is intended to provide general information and technical assistance for businesses to better understand the recent tax changes to the codes and identify credits or provisions that they must wish to explore. If you are interested in learning about information as it relates to filing for individuals, please be sure to check out our previously recorded webinar that's on Congressman McKenzie's web page at congressmanmckenzie.house.gov/services/webinars. I just want to go over a few housekeeping checks. First of all, we would like to note that this is a nonpartisan informational call, and it will not include discussions or opinions about the new policies or legislative positions. We ask that questions on this call today remain focused on implementation and available resources relating to the business owners and the business tax provisions for 2025. Please feel free to contact us by office or visit a website at congressmanmckenzie.house.gov to share your thoughts or opinions. Your mics will be set to remain in muted stations for the duration of this program, and if you have any questions, please place them into the chat box. After the completion of the presentation, we will go through the questions and answer them as time allows. We also want to reiterate that your tax situations are highly individualized. While we will try to cover common scenarios and try to answer questions in a generic level, not all questions can be addressed during our webinar today. If you have questions that require a deeper review or we cannot answer your question due to time, a member of our team will follow up with you after the call and help you connect with the proper resources. Please remember that the information shared today is for general education purposes and should not be considered an individual tax or legal advice. For specific information for your situation, you may want to contact a professional tax consultant. This webinar is going to be recorded and will be posted to our website upon conclusion as a resource for those who could not attend today. And we will send out a follow-up to notify you when it is available. With that, I would like to introduce you to our speaker, Kate Hunande, the Congressional Liaison for the Internal Revenue Service, who will conduct the presentation this afternoon. And with that being said, thank you, Kate, and please continue on.
Okay, thank you so much for having me. Again, yes, my name is Kate, and I do work at the Internal Revenue Service. I'm reticent to say that sometimes this time of year, but I work in the Office of Legislative Affairs, so I get to help taxpayers, so it's not so bad. Today, I'm going to provide an overview of the key business provisions of the 2025 legislation known as the One Big Beautiful Bill Act. I will probably refer to it as OBBB today as we're going along, just to save us all some time. But that is Public Law 119-21. The content in this briefing is based on the current information that is available on irs.gov, and the statutory legislative language is available at the Library of Congress website as well. So if you want to see the actual legislation, it's there. If you have questions, you can, after today's presentation, or you just want to see what else is going on with the legislation, please do visit the irs.gov website. Okay.
Kate, you're muted.
I guess instead of advancing my slide, I muted myself. So sorry. Thank you for letting me know. All right, let's start with some background on our first provision. As you may or may not be aware, there are payment settlement entities that are required to report the total yearly gross amount of payment transactions to both the IRS and the businesses that they contract with to receive payments. This is done via a Form 1099-K, and it includes things like credit or debit card transactions that are processed by banks or similar institutions. This also includes third-party network transactions, such as those processed through platforms like PayPal or Venmo. A third-party network transaction involves selling goods or services through that third-party payment network. And in order to qualify, there must be accounts set up with the central organization for many unrelated sellers. They must provide goods or services and agree to settle the transactions through the network. And it also must include standards and systems for settling these transactions and guarantee that the sellers receive payment. Networks that only process the payment, things like wire transfers or ACH transactions, do not have the contracts in place with sellers. So these are not considered third-party payment networks, and they are not subject to the same reporting. So a little bit of background, further background. Before 2022, the de minimis exception significantly reduced the reporting requirement by setting a high threshold. And the American Rescue Plan, which was passed in 2021, temporarily lowered the threshold to make the reporting requirements more abundant. And the OBBB legislation has restored the original limits that were in place. So it's been a little bit of a ping pong with this subject. So the de minimis threshold for third-party payment reporting reinstatement is such that organizations must report network transactions for the calendar year only if both of the following apply. The gross amount of payments made to the payee is more than $20,000, and the total number of transactions for that same payee is more than 200 for the 1 year. This revised de minimis payment exception also applies to the backup withholding rules, and the amended backup withholding rules apply to the years beginning after the 2024 tax year. So in summary, for calendar years after 2021, third-party settlement organizations must report their network transactions only when the gross payments for one payee exceed $20,000 and the gross amount of transactions exceed 200. Okay. Don't want to mute myself again. All right. I don't think I did. So moving on to our next change, starting with payments made after the 2025 tax year, the minimum dollar amount that requires information reporting for certain business payments has been increased from $600 to $2,000. This change applies to payments made by a payer to a payee during the payer's trade or business, including payments to non-employee workers such as independent contractors. Also, beginning with calendar years after 2026, the IRS will adjust that $2,000 amount threshold for inflation. So what this essentially means is that if you have a business and you pay less than $2,000 to another person for goods or service, well, for services they provide during the 2026 year, so during this year, you will no longer need to file a Form 1099 or send a copy to the payee either. I do want to mention, though, that even if the payee is not receiving a Form 1099 or you're not reporting it to the IRS, the payments are still taxable and they should still be reported on the tax return unless they meet some legal exclusion. But just because they're not being reported does not mean that they don't have to be included on a tax return. Again, this threshold also applies to the backup withholding rules. So beginning in 2026, payments below $2,000 are not treated as reportable for the purposes of backup withholding. This might apply to different 1099 forms. The most common are likely the 1099 NEC and the 1099 miscellaneous forms. Those are the ones that are used most commonly for this purpose. So the backup withholding does require a payer to withhold 24% of federal income tax from certain payments under the following criteria. I just want to mention them. That would be if the payee fails to provide a correct taxpayer identification number, If the IRS notifies the payer that that number is incorrect, if the IRS notifies the payer that the payee is subject to the backup withholding for various reasons, and also if the payee fails to certify that they are not subject to backup withholding. So, that's good for a lot of small businesses. I know my husband is a contractor, and I'm sure he will be excited that he doesn't have to worry about, sometimes he has independent contractors come along for a job, and he'll be excited that the threshold has increased. All right. Okay. Next, we're going to talk about bonus depreciation for qualified production property. Businesses can claim 100% bonus depreciation on qualified production property that they build between January 20th, 2025 and December 31st, 2028. And this property must be placed in service by December 31st, 2030. If a natural disaster delays placing the property in service, then the deadline may be extended. So what is qualified production property? Well, it is defined as new non-residential real property that qualifies for the regular maker's depreciation. It's located in the United States or its territories. It's used by the taxpayer as an integral part of a qualified production activity, and the original use of the property must begin with the taxpayer. Further, and lastly, the property cannot be leased to anyone else. The qualified production activities include manufacturing, production, and refining. And the activity must cause a substantial transformation of a qualified product, and production is limited to agricultural and chemical production. So there's different definitions depending on which type of production activity we're talking about. Some examples of property that is not qualified would be office buildings, administrative or sales facilities, research labs or software engineering spaces, lodging or hotel buildings, and parking structures. Those are considered real property, so most of those that are not qualified are real property items. Taxpayers may elect to take the 100% bonus depreciation for the qualified production property. It's their choice. And in order to do so, you must identify the property or the eligible portion of the property on the tax return when it's filed, and the election must be made in the year that the property is placed in service. Further, more detailed guidance on making elections will be forthcoming, so you can check irs.gov if you have questions about that. Taxpayers may also elect bonus depreciation for qualified use production property if it's acquired after January 19th, 2025, but before January 1st, 2029. Property, it does not qualify if the taxpayer used it in manufacturing, production, or refining prior to January 1st, 2021, and the taxpayer previously owned the property, or it does not meet the acquisition rules listed in the Internal Revenue Code. The date of a written binding contract controls whether the acquisition meets the eligibility period. So that's a lot of information. The key takeaway here is that businesses can claim a full 100% bonus depreciation on new qualified production property built between 2025 and 2028 if placed in service by 2030. It can also be claimed on certain used property acquired during the period, but not if it was owned or used earlier by the same taxpayer. Only property directly tied to manufacturing, production, or refining qualifies. Okay. All right. Beginning in 2026, businesses can no longer deduct expenses for employer-provided meals that are excluded from an employee's income or that are treated as de minimis fringe benefits, like small occasional perks, maybe coffee or snacks. However, employers may continue to deduct these expenses if they provide meals on certain types of vessels, on oil or gas platforms or drilling rigs, or at support camps for those types of operations. The law also expands the exception to the 50% meal deduction limit to include crew members on commercial fishing vessels. Employers can generally deduct 100% of the cost of food and beverages that are sold to customers and facilities which are used to prepare and serve these meals. A customer includes any paying individual, including employees who purchase meals. The deduction for employer-provided meals applies only to expenses incurred after 2025. So that means that for this year, employees may still deduct up to 50% of the cost of meals and related facilities when meals were provided on business premises, primarily for employees. And they also meet the qualifying requirements as defined in the Internal Revenue Code. All right. In tax years beginning after July 4th, 2025, taxpayers can elect to pay tax on the gain from the sale or exchange of qualified farmland property in installments rather than in one lump sum. Qualified farmland property means real property located in the United States that the taxpayer used as a farm or for farming purposes, or leased to a qualified farmer for farming purposes during substantially all of the 10-year period ending on the date or qualified sale of exchange. So that's quite a detailed situation that is described there, but I wanted to make sure we covered it in case your business is qualified for that. All right. Starting with tax years after 2025, the maximum amount that employees can exclude from their income for employer-provided dependent care assistance has increased from $5,000 to $7,500 per year. For married filing individuals, for married filing separate individuals, the amount is $3,750. As I said, the annual exclusion previously was $5,000 for most taxpayers, $2,500 for married individuals filing separately. The exclusion cannot exceed the employee's earned income, and if they're married, the lesser of the employee's or the spouse's earned income. Any amount over the annual limit does count as taxable income to the employee in the year the services are provided, even if the employee does pay for the services in a subsequent year. What is included in dependent care assistance is payments for services or the provision of services that allow the employee to claim the child and dependent care credit. The expenses must relate to household services or care of a child for another other dependent so that the employee can work or can look for work. Employers may offer dependent care assistance through a flexible spending arrangement, also known as an FSA, as part of a cafeteria plan, but to qualify, the plan generally cannot favor any highly compensated employees. Forgive me, we are going to get a little technical now. You might be thinking we already did, but we are going to get more so for this particular topic. Starting with tax years beginning after 2024, the IRS will calculate something called adjusted taxable income, or ATI, for business interest deduction limits using something called EBITDA, or EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. This will replace the former computation, which was just based on earnings before interest and taxes. So the change increases the cap on the deductible business interest expense because it will now include the D and the A, the depreciation and the amortization deductions. For tax years beginning after 2025, ATI will also exclude certain foreign income that U.S. shareholders must otherwise recognize. This does not include Subpart F income, net CFC tested income, or gross up amounts as defined in the Internal Revenue Code. Participation exemption deductions under IRC, that's Internal Revenue Code 245, and foreign derived intangible income are also included in the exceptions, in the exclusions, which are, as I said before, you can find more information in Internal Revenue Code section 245 and 250. The EBITDA limitation, as I said, applies only to tax years starting after 2024. So it would be in place for this filing season that we are in now, but it is not retroactive. All right. The interest deduction limitation is calculated before applying elective or mandatory interest capitalization rules. So interest that is capitalized under our Internal Revenue Code 263 does not count as business interest for this purpose. Businesses must apply the limitation first to amounts that would be capitalized and then to amounts that would be deducted. So carry forward interest amounts are not treated as business interest subject to the capitalization provisions. The EBITDA-based ATI calculation, as I said, applies to tax years starting after 2024, but the foreign income exclusion will start after 2025. So, I was going to summarize it, but I think I just did. I'll summarize it yet again. All right. The Internal Revenue Code 179 deduction, you probably are familiar with many different code sections, but this is one you might have heard of before. It's pretty common and it's included on 1040 tax returns as well. So that limitation has increased from $1 million to $2.5 million, and the investment limitation has increased from $2 to $4 million for tax years beginning after 2024. Also, beginning after 2025, these amounts will be adjusted for inflation going forward, and that inflation adjustment is based on the cost of living as determined under the Internal Revenue Code for the calendar year in which the tax year begins. Of note, the legislation does not increase the 179 limitation for sport utility vehicles. Unfortunately, those are not included in the favorable increase. Okay, slide 12. The law now automatically treats certain payments that a partnership makes to a partner for property or services as if they were made to a non-partner. These rules take effect on their own. They no longer require IRS or Treasury to issue regulations to apply them. And even though the regulations are no longer needed in order for the rules to apply, the IRS will still have the authority to limit or adjust how these rules work through future regulations or guidance. I suppose as issues arise, the IRS may need to weigh in on things that we may not know are issues yet. So the rules apply only to services performed and property transferred on or after July 4th, 2025. It does not change or imply anything about how transactions were treated prior to that date. All right, there will be a phased increase in the exclusion for gain from qualified small business stock. So for a taxpayer other than a corporation, gross income does not include 50% of any gain from the sale or exchange of qualified small business stock acquired on or before July 4th, 2025 and held for more than 5 years. Also, we will now be using a tiered exclusion system based on how long the taxpayer holds the stock. And here we can see that on this chart. There will be a 50% exclusion for stock held at least 3 years, a 75% exclusion for stock held at least 4 years, and a 100% exclusion for stock held 5 years or more. The amendment also raises the limits for stock acquired after July 4th, 2025. So the per issuer dollar limit increases to 15 million, and inflation adjustments will begin in 2026. The aggregate gross asset limit increases to 75 million, which will also be adjusted for inflation. All right. The law, the OBBB law, makes the qualified business income deduction permanent starting in tax years after 2025. It also modifies the phase-in limits for the deduction, and it adds an inflation adjusted minimum deduction as well. So for tax years beginning after December 31st, 2017 and before January 1st, 2026, individuals, trusts, and estates can deduct 20% of their qualified business income from a partnership, S corp, or sole proprietorship. They can also deduct 20% of combined qualified dividends and publicly traded partnership income. Special rules do apply to domestic production activities of certain agricultural and horticultural cooperatives. Taxpayers can take this QBI deduction when calculating taxable income, but not as opposed to adjusted gross income. And the deduction is available whether or not the taxpayer itemizes deductions. So if you take the standard deduction, that does not preclude you from taking this QBI deduction. It cannot exceed 20% of the taxable income, however, after being reduced by net capital gains. So taxable income minus net capital gains, that QBI cannot exceed 20% of that figure. Also, the deduction for income and specified service trades or businesses is phased out once taxable income exceeds a set threshold amount. The new law also expands the income phase-in limits for the deduction. So for single filers, the threshold increases from $50,000 to $75,000. For married filing jointly, the threshold increases from $100,000 to $150,000. Further, OBBB creates a minimum deduction of $400 adjusted for inflation for taxpayers who earn at least $1,000 in qualified business income from one or more active businesses in which they materially participate. These changes give small business owners a higher baseline deduction, and they ensure that the deduction will grow with inflation starting in years after 2025. The law also increases employer-provided child care credit, starting with amounts paid or incurred after 2025. Employers can now claim a credit equal to 40% of qualified child care expenses up to a maximum of $500,000 per year. This is an increase from the previous 25% credit and $150,000 cap, so a pretty significant increase. Eligible small businesses can claim a 50% credit up to a maximum of $600,000 per year. So if you're a small business, you get even more. You get a 50% credit rather than 40, and you get that extra $100,000 of maximum credit also. A business qualifies as small if it meets the gross receipts test defined in the Internal Revenue Code, which generally defines gross receipts under $31 million for 2025 as a small business. For the credit, the IRS calculates the average gross receipts over the prior 5 tax years. Generally, when calculating that figure, we would use 3 years, but for this provision, it's over 5 years. Also, starting after 2026, the $500,000 and $600,000 limits will be adjusted annually for inflation, and small businesses may combine resources to jointly own and operate qualified child care facilities or a child care facility. Businesses may also use a third party to provide the child care services for employees instead. OBBB makes the employer credit for paid family and medical leave permanent, starting with tax years after 2025. Employers can claim the credit for either wages paid to qualifying employees while on leave or a percentage of their insurance premiums that were paid for family and medical leave coverage. They cannot claim both for the same employee. Starting in 2026, employers may claim a credit for 12.5% to 25% of the premiums paid during the tax year for qualifying insurance policies that provide family and medical leave benefits. The law reduces the employer's deduction for insurance premiums by the amount of credit claimed for those premiums. Again, because you can't claim both. Also, starting in 2026, a qualifying employee must normally work at least 20 hours per week, and employers may choose to lower the minimum employment period from 1 year to 6 months if they feel that's appropriate. So for part-time employees, the employer does annualize their compensation to determine that it does not exceed 60% of the highly compensated employee threshold from the prior year. Employers must also include state and local government mandated paid leave when they calculate the total amount of leave provided. However, the state and local mandated leave does not count toward the credit amount. There is also a general rule that says an applicable tax-exempt organization must pay a 21% excise tax on any remuneration over $1 million paid to a covered employee in a tax year and any excess parachute payments paid to a covered employee. Previously, a covered employee was one of the 5 highest paid employees for the current year, or any employee who was previously a covered employee for any tax year after December 31st, 2016. Now, the new law removes the limit that previously applied to the excise tax on excessive compensation, and starting with tax years beginning after 2025, that 21% excise tax applies to any employee who receives more than $1 million in pay or excess parachute payments, rather than just the 5 highest paid employees. Also, starting with tax years after 2025, corporations can deduct charitable contributions only if the contributions exceed 1% but are less than 10% of the corporation's taxable income. Corporations may carry forward contributions that exceed the 10% limit for up to 5 tax years using the first in, first out method. The corporation must apply current year contributions first and then apply any carry forward amounts. The carry forward contributions that might be disallowed under the 1% floor may be carried forward if in that year the total contributions exceeded the 10% limit. And if a corporation has a net operating loss or NOL carryover, it must reduce the charitable contribution carry forward to avoid increasing the NOL amount in later years. The 1% floor and 10% limit do not apply to qualified conservation contributions by corporate farmers or ranchers, or to contributions by native corporations. An excess business loss happens when the taxpayer's total business deductions are greater than their total business income or gain for the year, plus an inflation-adjusted threshold amount of $626,000 for married filing jointly filers or $313,000 for all other taxpayers. The OBBB legislation makes the excess business loss limitation permanent. This means that non-corporate taxpayers cannot deduct any excess business loss in the year that it occurs. Capital losses from selling or exchanging assets do not count as business deductions, and capital gains are counted only up to the smaller of net capital gain from the trade or business or total net capital gain. Wages from being an employee also do not count as business income for this rule. In summary, non-corporate taxpayers must now permanently defer excess business losses, turning them into NOL carryovers, net operating loss carryovers, and the rule eliminates the ability to deduct large business losses in the same year that they occur. The current 40% bonus depreciation rate is increased to 100% for qualified property acquired after January 19th, 2025. Specified plants acquired and planted or grafted after January 19th, 2025 also qualify for the 100% bonus depreciation. Qualified property acquired before January 20th is subject to the prior bonus depreciation rate for the year the property is placed in service. Thus, the bonus rates are as follows: 40% for property placed in service after December 31st, 2024, before January 1st, 2026. 20% for property placed in service after December 31st, 2025 and before January 1st, 2027, and 0% for property placed in service after December 31st, 2026. Unlike other properties subject to bonus depreciation, for specific plants, it is the date that the plant is planted or grafted that determines the rate, not the actual acquisition date. Okay, we're getting there. We're almost there. Starting after 2024, taxpayers can immediately deduct domestic research and experimental costs, R&E costs, I might call them that, in the year that they are paid or incurred. However, taxpayers must capitalize and amortize foreign R&E costs over 15 years. So domestic R&E costs include expenses related to the trade or business for activities conducted inside the United States, and they exclude land acquisition or improvements, depreciable property, and mineral exploration. Taxpayers may choose to amortize domestic R&E costs over at least 60 months, beginning in the month the benefits first arise, but they can also elect a 10-year amortization period as well. Foreign R&E costs are related to research conducted outside the United States. As I said, these must be amortized over 15 years. Starting with tax years after 2024, the research credit applies only to domestic R&E costs, and taxpayers must reduce their R&E deduction by the amount of any research credit claimed. There are special rules for small businesses. Again, these are businesses with annual gross receipts of 31 million or less. They may retroactively apply the change to tax years beginning after 2021, but they must make this election by July 4th of this year by filing amended returns for the affected tax years. So there is a deadline on that. If that applies to you, you can choose to change your amortization period for tax years prior to 2021, but you have to do so by amending your tax returns no later than July 4th. The commercial clean vehicle credit is ending early. Taxpayers cannot claim the credit for any qualified commercial clean vehicle acquired after September 30th, 2025. The original expiration date was the end of 2032. Similarly, the 5-year cost recovery for energy property is also eliminated. The amendments apply for property that begins construction after December 31st, 2024. So if the construction began prior to December 31st, 2024, it still applies. The advanced manufacturing production credit also begins to phase out and faces new restrictions starting in tax years after July 4th, 2025. Wind components are not eligible for the credit if they are produced and sold after the end of 2027. Metallurgical coal is also not eligible if it's produced after 2029, and the credit rate drops to 2.5% starting in tax years after July 4th, 2025. For other applicable critical minerals, the credit phase out is as follows. 2031, 75% of the original credit allowed. 2032, 50% of the original credit allowed. 2033, 25%, and 2034 and beyond, no credit allowed. Starting with tax years after 2026, integrated components must be produced in the same facility as the secondary components they are built in order to qualify for the credit, and at least 65% of the production cost of the secondary component must come from domestic primary components. New restrictions also apply to foreign entities beginning after July 4th, 2025. A taxpayer cannot claim the credit if it qualifies as a specified foreign entity. A taxpayer cannot transfer the credit to any specified foreign entity. A component does not qualify for the credit if it includes material assistance from a prohibited foreign entity. The clean electricity production credit ends for wind and solar facilities placed in service after 2027 as well. The termination applies to facilities that begin construction after July 4th, 2026. The credit also faces new restrictions starting in tax years after July 4th, 2025, including no credit for leased wind or solar property, Credit is denied for projects involving prohibited foreign assistance or foreign control. Only new capacity at older facilities can still qualify. And Treasury will use existing studies to set the emission standards. Also, for qualified fuel cell property beginning construction after 2025, the credit increases to 30%. Greenhouse gas emission requirements are waived for the qualified facility where the property is installed. Also, for construction starting after June 16th, 2025, the domestic content requirement is stricter. A higher percentage of steel, iron, or manufactured components must be produced in the U.S. in order to qualify for the domestic content bonus credit. Also, the IRC 48 energy credit is eliminated for the following types of property if construction begins after June 16th, 2025. It's qualified microturbine property, solar energy property, and geothermal energy property. The new energy efficient home construction credit also terminates early and may not be claimed for any qualified home acquired after July 1st of this year, rather than July 1st of 2033 as originally planned. Similarly, the energy efficient commercial buildings deduction is also terminated for construction starting after June 30th, 2026. And with that, we have made it. We have made it through. I think we've covered all that you could possibly want to know about the business provisions in OBBB. I thank you for bearing with me. And as a reminder, you can find all of this information along with any new guidance that is still forthcoming available at the irs.gov website. Thanks for sticking it out with me, especially when it got technical there. I do hope this was helpful and informative, and at least you know where to look for things if you need them in the future. So thanks so much.
Thank you, Kate. You've shared a lot of valuable information with us. We do have one question here. Someone would like you to elaborate on the updates to the immediate expensing and when they can be applicable.
Okay, so the immediate expensing for, I assume that's for the 100% depreciation. Let me just find that. 1 second. It's way back there, I think. Okay, so I'll just go over it really quickly. It's for the I'm assuming it's for the qualified production property, and that says that businesses can claim 100% of the depreciation on qualified production property that they build between January 20th, 2025 and December 30th, 2028. It must be placed into service by the end of 2030. But if there's a natural disaster which delays putting it in service, then the deadline may be extended. And then if it's related to the other general depreciation, just in case, let me cover that as well. Sorry. Okay, so basically there's a current bonus depreciation rate of 40%. It's increased to 100% for certain qualified property other than the qualified production property. I don't have a list of the type of qualified property that is included at this time, but I'd be happy to find one and I can provide it to your office if the constituent would like to reach out and provide their contact info. I'd be happy to find that out. I hope that was it. I hope that's what they wanted to know.
Kate. Yep. Thank you. We have one additional question. Do you have any planning tips for a business to take on now before the year end and the preparation for their future years?
Well, related specifically to the OBBB legislation, I would just take a look at the resources that are out there. There's a lot of dates floating around, as I'm sure you heard, where that qualifying dates for certain deductions and when things are going to start. happening. You know, some of them apply this year, some of them don't. So I would take a look at that. General tips just for any tax filing, you know, keeping good records and making sure that you're, you know, keeping an eye out for any credits or deductions that might apply to you that you didn't know about before. There's actually a small business section on the irs.gov web page that's devoted to resources and you know, forms and publications specifically for a small business, and it's a really good resource. I would recommend taking a look at that. And otherwise, I can't think of anything specific other than that, but good record keeping is probably the number one tip I can offer.
Well, thank you for that. And thank you to all of you for attending today. We will be sure to follow up any questions or emails that we received after this presentation. If you have additional questions that you feel you need to contact our offices, please do so. You can also send us a submission on mackenzie.house.gov. And thank you again to Kate and everyone for attending.
Thank you.